A warm welcome to another episode of Insync with BDO India. Recently, in September 23, the Reserve Bank of India issued Master Direction on Classification, Valuation, and Operation of Investment Portfolio of Commercial Banks, Directions 2023. In today's episode, we have Tushar Kurani, Chartered Accountant, Partner Audit and Assurance MSKA and Associates, with us to discuss these changes, which are mainly relating to matters pertaining to investments. Thank you for joining us, Tushar, and over to you.
Thanks, Pallavi. Welcome, everybody. Today, we will discuss on key changes in the 2023 directions pertaining to investments. Commercial banks are currently required to follow the Master Direction 2021 on investment for classification and valuation of their investment portfolio. The 2021 directions are largely based on the framework introduced in October 2000. In view of the significant development in global financial reporting standards, the linkages with the capital adequacy framework, as well as progress in the domestic financial markets, revised regulatory framework for the investment portfolio is being issued. On 14th January 2022, the Reserve Bank of India issued a discussion paper proposing revisions to the existing norms governing the classification, valuation, and operation of investment portfolio held by commercial banks. After a period of considering the feedback on the discussion paper, the Reserve Bank of India has now taken the next step by issuing the Master Direction 2023, which was officially released on 12th September 2023. The revised framework updates the regulatory guidelines and global standards and best practices while introducing a symmetric treatment of fair value gains and losses, a clearly identifiable trading book under held for trading, removing the 90-day ceiling on holding period under HFT, removal of ceiling on held to maturity, and more detailed disclosure on the investment portfolio. Further, to facilitate smooth implementation, illustrative guidance has been developed on the revised framework and annexed to the directions. It will be applicable from 1st April 2024 to all commercial banks, excluding regional rural banks. The provision of this direction shall be applicable to small finance banks and payment banks insofar as this provision are not in conflict with the guidelines for licensing and operating guidelines for small finance banks and payment banks. The 2023 directions are largely aligned with the principle of Ind AS and also outline a comprehensive investment policy framework which includes guidelines on risk management, reporting requirements, etc. The key changes in 2023 directions mainly relate to the following matters pertaining to investments, that is, classification of investments, reclassification of investment, recognition and measurement, valuation, transition, derivatives, and disclosures. The following section set out the key requirements covered in the 2023 direction and will also compare with the key differences from the 2021 direction. Classification of investment. Banks shall classify their entire investment portfolio except investments in their own subsidiaries, joint ventures, and associates under three categories: held to maturity, available for sale, and fair value through profit and loss. Held for trading shall be a separate investment subcategory within the fair value through profit and loss. The category of investment shall be decided by the bank before or at the time of acquisition, and this decision shall be properly documented. All investment in subsidiaries, associate, and joint ventures shall be held in a distinct category separate from other investment categories, that is HTM, AFS, or FVTPL. Classification of similar securities, including SLR and non-SLR securities, even if acquired at the same point of time or in the same lot, can be classified under different categories if acquired with different objectives. The objective should be clearly established and documented before or at the time of acquisition. As per 2021 directions, the banks are currently required to classify their entire investment portfolio under three categories: held to maturity, available for sale, and held for trading. Investment in equity of subsidiaries and joint ventures would be eligible for inclusion in HTM category. Basis for classification of HTM, AFS and FVTPL. HTM securities. The securities is acquired with the objective of holding it till maturity. That is, the financial assets are held with the objective to collect the contractual cash flows, and these contractual terms give rise to cash flows that are solely payments of principal and interest on principal outstanding on a specified dates. Whereas 2021 direction prescribes certain securities the investment in which would be eligible for inclusion in HTM. This include SLR securities, certain non-SLR securities, equity of subsidiaries and joint ventures, long-term bonds issued by infrastructure companies, unquoted securities of category 1 and 2, alternate investment fund for certain period. As per 2021 directions, investment under HTM category should not exceed 25% of the bank's total investments. And as per 2023 directions, there is no such limit on investment under the HTM category. Moving to AFS securities. The securities is acquired with the objective that is achieved by both collecting contractual cash flows and selling securities, and the contractual terms of the security meet the SPPI criteria. AFS security shall include debt securities held for asset liability management purposes and meet the SPPI criteria where the bank intent is flexible with respect to holding securities till maturity or selling before the maturity. Whereas per 2021 direction, AFS is a residual category. This security which do not fall under HTM or HFT category are classified under AFS. Moving to next category, that is FVTPL securities. Securities that do not qualify for inclusion in HTM or AFS shall be classified under fair value through profit and loss. As per 2021 direction, securities acquired with the intention to trade by taking advantage of the short-term price, interest rate movement would be classified under HFT. Investment classified under HFT should be sold within 90 days, whereas per 2023 direction, the FVTPL category or the HFT subcategory do not stipulate a period within which the investments in that category need to be sold. Moving to reclassification between the categories. After transition to this framework, banks shall not reclassify investment between categories, that is HTM, AFS and FVTPL, without approval of their board of directors. Further, reclassification shall also require prior approval of the Department of Supervision of Reserve Bank of India. The reclassification should be applied prospectively from reclassification date. When a bank reclassify investments from one category to another category, the bank shall disclose the detail of such reclassification, including the reclassification adjustment in the notes to the financial statements. Whereas per 2021 directions, bank can shift investment to or from HTM category once a year with the approval of the board of directors. Additional shifting during the year would require RBI approval. With respect to reclassification from AFS to HFT, this is permitted with the approval of the board of director of the bank or asset liability committee or investment committee. With respect to reclassification from HFT to AFS, shifting of investment from HFT to AFS is not permitted. Moving to next on recognition and measurement. The RBI has incorporated comprehensive guidelines for accounting treatment across various scenarios like initial recognition, subsequent measurement, and reclassification. These directions have been introduced to address ambiguities and bring uniformity throughout the banking industry. Initial recognition and measurement. All investment shall be measured at fair value on initial recognition, unless facts and circumstances suggest that the fair value is materially different from the acquisition cost. It shall be presumed that the acquisition cost is the fair value. However, in certain cases, the acquisition cost may overvalue the investment, leading to distortion both in value of the assets and equity as well as the regulatory capital of the reporting entity that invested in such instruments. Thus, the requirement introduced by the RBI to undertake the initial recognition at fair value is a welcome step, and it is in line with Ind AS, where the securities are quoted or the fair value can be determined based on market observable input such as yield curve, credit spread, etc. Any day one gain or loss shall be recognized in the profit and loss account under Schedule 14, Other Income, within the subhead Profit on Revaluation of Investments or Loss on Revaluation of Investment, as the case may be. Any day one loss arising from Level 3 investment shall be recognized immediately. Any day one gain arising from Level 3 investment shall be deferred. In the case of debt instrument, the day one gain shall be amortized on a straight line basis up to the maturity date, while for unquoted equity instruments, the gain shall be set aside as a liability until the security is listed or derecognized. Whereas for 2021 direction, investments are initially recognized at acquisition cost. Moving to subsequent measurement. Securities held in HTM shall be carried at cost and shall not be marked to market after initial recognition. However, they shall be subject to income recognition, asset classification, and provisioning norms. Any discount or premium on security under HTM shall be amortized over the remaining life of the instrument. As per 2021 directions, investments classified in HTM are required to be assessed for impairment. Accordingly, there are no substantial change in this regard as compared to 2023 directions. Moving to AFS. The securities held in AFS shall be fair valued at least on a quarterly basis, if not more frequently. Any discount or premium on the acquisition of debt securities under AFS shall be amortized over the remaining life of the instrument. However, they shall be subject to income recognition, asset classification, and provisioning norms. The valuation gains and losses across all performing investments, irrespective of classification held under AFS, shall be aggregated. The net appreciation or depreciation shall be directly credited or debited to the reserve named AFS reserve without routing through profit and loss account. Upon sale or maturity of debt instrument in AFS category, the accumulated gain loss for that security in the AFS reserve shall be transferred from the AFS reserve and recognized in the profit and loss account. Where, as per 2021 directions, the requirement to fair value the AFS investment is the same. The treatment of net appreciation and depreciation of valuation gain is different. The net depreciation on AFS investment is currently required to be provided for in the profit and loss account, and the net appreciation is to be ignored. Profit or loss on sale of investment in the AFS category is required to be taken to profit and loss account. FVTPL. The security held in fair value through profit and loss shall be fair valued, and net gain or loss arising on such valuation shall be directly credited or debited to profit and loss account. Securities that are classified under HFT subcategory within FVTPL shall be fair valued on a daily basis, whereas other securities in FVTPL shall be fair valued at least on a quarterly, if not on a more frequent basis. Any discount or premium on acquisition of debt security under FVTPL shall be amortized over the remaining life of the instrument. Securities under FVTPL shall be subject to income recognition, asset classification, and provisioning norms. As per 2021 directions, individual security in HFT category are required to be marked to market on a monthly basis or more frequent interval, whereas per 2023 direction, this is to be done on a daily basis for HFT and quarterly basis for other securities. The net depreciation on HFT investment is currently required to be provided for, and net appreciation is to be ignored. All investments, that is including debt and equity in subsidiary, associate and joint venture, shall be held at acquisition cost. Any discount or premium on the acquisition of debt securities of subsidiary, associate and joint venture shall be amortized over the remaining life of the instrument. Bank shall evaluate investment in subsidiary, associate or joint venture for impairment at least on a quarterly, if not more frequent basis. As per 2021 direction, the investment in subsidiary, associate and joint venture are currently classified under HTM. Accordingly, measurement regulation applicable to HTM instrument investment would be applied. Valuation. The fair value for the purpose of initial recognition and periodical valuation of investment are required by this direction shall be determined as per the valuation norms. The RBI has included fair valuation requirements along with accounting treatment for gain or loss, ensuring that investment portfolio are assessed accurately, reflecting their current market values. All investments now shall be measured at fair value on initial recognition. Fair value measurement of investment is based on the categorization into level 1, level 2 and level 3 inputs. Net unrealized gains recognized in the profit and loss account or in the AFS reserve, which is arising on fair valuation of level 3 instrument, would be deducted from Tier 1 capital and not be available for payment of dividend. The categorization of investment portfolio into level 1, level 2 and level 3 is a new requirement prescribed by 2023 direction. This is currently not there in 2021 direction. Moving to transition. At the time of transition of these directions, that is on 1st April 2024, banks shall reclassify their investment portfolio as at 31st March 2024 as per the directions. The balance in provision for depreciation as at 31st March 2024 shall be reversed into the revenue or general reserve. The balance in investment reserve account, if any, as of 31st March 2024 shall be transferred to revenue or general reserve if the bank meets the minimum regulatory requirement of investment fluctuation reserve. If the bank does not meet the minimum fluctuation reserve requirement, the balance in the investment reserve account shall be transferred to investment fluctuation reserve. Suitable disclosure of transitional adjustments made should be disclosed in notes to the financial statement for the year ending 31st March 2025. As per the 2021 directions, the excess provision on account of depreciation of investment in the AFS or HFT category is appropriated to investment reserve account. This would be included as a part of Tier 2 capital of the bank, and the same has been discontinued under the 2023 direction. Investment fluctuation reserve remain unchanged as compared to 2021 directions. Derivatives. Bank should comply with the requirement of guidance note on accounting for derivative contracts issued by Institute of Chartered Accountant of India, except for the current and non-current classification. Bank shall present their derivative assets and liabilities as separate line items under Schedule 11 Other Assets and Schedule 5 Other Liabilities respectively. Banks may make adjustments to the carrying value of their investments in compliance with the hedge accounting requirement of the said guidance note. Moving to disclosures. Disclosures are intended to facilitate an evaluation of the significance of the financial instruments in the entity's financial position and performance. The 2023 directions have enhanced the disclosure requirements pertaining to investments held by banks. Some of the key disclosures required to be provided in notes to the accounts in the financial statement. Carrying amounts and fair value. Carrying amounts and fair value of each of the category, that is HTM, AFS, FETPL, and each class, that is government securities, other approved securities, shares, debentures and bonds, subsidiaries, associates and joint venture, others. This disclosure are required the categorization and class of investment made outside India. This disclosure will be effective from 31st March 2025. Moving to next, gain or loss on investment. Gain or loss for each category of investment that has been recognized in profit and loss account or in the AFS reserve to be disclosed. This will be effective from 31st March 2025. Moving to next, disclosures as per fair value category, that is level 1, level 2 and level 3. For each class of investment, banks would need to disclose the investments that are subsequently measured at AFS and FVTPL basis the fair value category need to be disclosed. This will be effective from 31st March 2026. Disclosure of sales made out of HTM. This disclosure included the opening carrying value of investments in HTM, carrying value of investments sold, which excludes the carrying value of investments sold that are exempted from the regulatory limits, and the amount transferred to capital reserve in respect of HTM securities sold at a gain. This will be effective from 31st March 2025. Transition related adjustments. Bank shall make suitable disclosure of all the transitional adjustments made in their notes to the financial statement for the financial year ending 31st March 2025. The detailed disclosure are given in Direction 2023 as Annexure 2. With the implementation of this direction, 2021 direction shall stand repealed. Regulatory supervision. The RBI has introduced additional supervision on the investment portfolio of the bank and the bank's compliance with these directions. Implementation of this direction shall be reviewed under the supervisory process, and any non-compliance in this regard shall be dealt with appropriately by the RBI. This highlights provide an overview of the key expectations outlined in the RBI's directions regarding the classification, valuation, and operation of investment portfolios for commercial banks. These guidelines are designed to enhance transparency and consistency. So with this, we have come to an end for today's Insync episode with BDO India. Hope you found this session informative. For any further clarification, you can connect with BDO Marketing at marketing@bdo.in. Thank you.